Hello, welcome back to Weekly Market Recap here with Knight this week. Let's get to it. So this past week, we saw the NASDAQ down 5.48%, which brings us down year to date 26.83%. The S&P 500 we saw down 4.77%, which brings us down year to date 18.73. And after the past few weeks of seeing somewhat of a recovery or stability, we had a big drop this week, and it's all because of the CPI, or as I begrudgingly call it, the CP lie, because it just lies to us over and over again. But let's jump into it and see what the market did this week. Just looking at this graph, I'm sure you can tell which day the CPI numbers came out. To start the week on Monday, we were fine, and then the report came out. We missed expectations, and we saw some really scary things going on in core. And so we had a big sell-off, but really just sell-off continued. And then on Friday, we had some bad news come out from FedEx, specifically around earnings and a slowdown, which led a lot of investors to panic as well. And we saw another sell-off go into Friday. We did recover a little bit end of the day, but the week as a whole was really red, and we'll talk a little bit more about what specifically happened. So the main thing we need to talk about is what happened with CPI. So the good news, and maybe the only good news, is that we have seen both the headline number fall, continue to go down, and we did see the month-over-month data for all of it come in relatively low. But with this graph, someone would say, I don't understand why then the market fell so much. 0.1 should be a pretty good number. Well, expectations were we were actually going to see a negative 0.1, so we missed high on there. But this graph really shows what was scary about the last reading. So we see the all items in the blue up here, and we understand that it's peaked back in June and it started to trend down. But a big part of that has been gas. We knew that energy prices had been going down. However, core, which had peaked back in March, had been steadily going down until, now it's going up. And that right there is enough to really spook the markets. So why did core miss? So the first thing we have to do is, again, go all items, less food and energy. So this is what core is. And again, we came in at 0.6. People were hoping that core would be, again, back what we saw in July, 0.3. So it was hoping that we would stabilize there and continue to go down. We didn't see that. And so we actually saw a number that jumped back up to what we saw April, May. And the worst part of it is right here under shelter. So shelter is a lagging indicator, but it's also really sticky. And sticky means that it's going to be around for a while. So seeing this number trending up and going up significantly is the exact opposite of what the economists were hoping. People were really hoping that we were going to, we peaked back at 0.6, 0.5, maybe we got another 0.5 or 0.4 going down. But again, 0.7 means that annualized, that's an 8.4% in shelter costs. And shelter, again, is really sticky. All right, so here's the entire breakdown. And what I really want you to notice is the broad-based nature of it. So we were in at 0.6, but there are some negatives, but just a lot of positive, like laundry equipment. Why is that up 6.9%? We have women's dresses, so some apparel going down, but even then, apparel as a whole still went up. And this was one of those stories where there was supposed to be a lot of inventory. We were supposed to see price cuts in apparel, but that hasn't really been happening. Now, there's been a couple of, I guess, inventory stories like televisions, but for the most part, we're still seeing vehicle accessories with tires up over, around 1%. everything on this entire list, for the most part, is still going up. And on a month over month basis, significant. But then when you annualize it at that rate, it's still really way too high. And again, this was really the killer, was the rent of primary residence, this going up for the most part, and shelter going up significantly from 0.5 to 0.7 was a really bad miss. And then owner's equivalent rent, the fact that we didn't peak and start going down, we started to go back up, means that this whole storyline of inflation has peaked and we're going to see it keep trending down. The Federal Reserve can relax a little bit. Equities can go on a run until the end. Well, now we've just pushed this whole story off at least another month or two, and leads perfectly into another reason why the market is a little spooked. Next week, we have the Fed meeting on September 21st, and they are going to decide to hike interest rates again. People were hoping after the CPI, if it had come in low and good for the market, we might have seen a softening. Maybe the Fed would only have to do 50 basis point hike, or maybe if it came out really great, we could do a 25 basis point hike. Now we've almost guaranteed at least a 75 basis point hike. And now, after that awful reading this week, some people are even calling for a full 1% hike in the federal funds rate, which means we're not pausing, we're not slowing down, we might even be increasing. And the more rapidly that the Fed has to increase, the worse and more likely of a recession that we could go into, and for a longer time. So it's really why the market reacted so violently. If you look at just a few of the graphs, it might not seem that bad, but when you get into the numbers and the expectations that we had and the hope of the end of the year is going to be a lot softer, inflation's going to come down, we're just not seeing that in the data. And if anything, the worst parts of that data to be going higher were, and thus the market reacted violently, and we were down 4 or 5% this week. Now, it could be that the market's having a slight bit of an overreaction. Overall, we know that the Fed is they are very committed to lowering inflation. They're going to be on this fight until inflation's low. And I think for the most part, even though we've come down significantly, we hit our market lows back in June, and it probably would still need a lot worse inflation pain to get back that low. So we probably are still in this period where we'll be trading rapidly between where we are right now and maybe where we were 2-3 weeks ago, which was about 1,000 points higher on the NASDAQ and about 400 points higher on the S&P 500. So that's, for some degree, the range that I could see. We get some weeks of good news, we rise rapidly back up, we gain that 5% back. And if we see bad news after that, this really volatile place within this range. Now, everything could always change if the Fed pulls something big, or if we get some other worse global economic news, or if we get some positive economic news. Overall, we had a market that was really thinking and hoping that we had seen the worst of inflation and we were going to continue this trend. And honestly, even the economists thought, there's only one economist that ended up actually predicting the numbers that we got. Everyone else thought we were going to be lower. So even the people who are the smartest, who are reading the tea leaves, reading the economy, are right on the ground, they're getting it wrong. Only 1 out of 64 economists got it right. So the majority of people don't really understand where inflation is right now and how long it's going to be. But the market was pricing in that more optimistic view, and it really just slashed that possibility, at least for the next month or two. And because of that, we saw the market react accordingly. So appreciate you guys tuning in this week. As always, I'm here to support you. Your money's here to support you, and we'll see you again next week.